feeling a bit uneasy about the markets lately?
Yeah, I think a lot of people are.
You're definitely not alone. So today, we're diving deep into a collection of companies that, historically haven't just weathered market storms, but have consistently rewarded their shareholders. Through thick and thin, really.
We're zeroing in on the Dividend Aristocrats. Now, these aren't your flashy high-growth stocks that grab all the headlines.
No, not at all.
These are well-established businesses, the kind that have consistently increased their dividend payouts for at least 25 years straight. Think of them as, I don't know, the bedrock of a resilient portfolio.
Exactly. Bedrock, cornerstone, whatever you want to call it. And in this deep dive, we've sifted through our sources to bring you 9 specific Dividend Aristocrats. These look particularly well-positioned, not just to survive, but maybe even thrive, regardless of what the economy throws our way.
Okay.
We're going to unpack what makes them so dependable and why they might be smart considerations if you're looking for stability and consistent returns, of course.
And the aim is to give you a clear picture of their strengths, right? Without getting too bogged down in, super complex financial jargon.
Yeah, keep it accessible.
What's particularly interesting about this group, I think, is the breadth of industries they represent. We're not just looking at one sector here.
Good point.
We'll be exploring opportunities in healthcare, consumer staples, those everyday necessities,
right,
industrials, and even consumer discretionary. So it gives you a really diverse snapshot of potential stability.
Okay, let's unpack this then, starting with a real heavyweight, Johnson & Johnson, ticker J&J.
J&J, a classic.
Currently yielding around, 3.1%? And they have an astonishing 62-year streak of dividend growth. 62 years.
It's incredible.
Our source describes this healthcare giant as the corporate equivalent of a Swiss watch, precise, reliable.
Built to last. Yeah, that's a great analogy. Yeah. And what's strategically significant for J&J right now is their recent move, spinning off their consumer health division.
Kenvue, yeah.
Into that separate company, Kenvue.
Yeah.
If we look at the bigger picture, this lets Johnson & Johnson really kind of concentrate on what drives their growth.
Yes.
Their pharmaceutical and medical device divisions. That's the core now.
Right. And our source highlights some of their key drugs, like Stelara and Darzalex, along with their, cutting-edge surgical technologies. Those seem to be major engines for future growth and increasing that free cash flow.
That cash they generate after covering costs.
Exactly. The money that can fund dividends, buybacks, R&D. So considering that healthcare is pretty much a constant need, it seems J&J is well situated to keep delivering and rewarding its investors.
Yeah, it really does. And that raises an interesting point for you to consider. How much weight do you give the sort of inherent stability of the healthcare sector when you're looking at investments?
Good question.
Now let's shift gears. Another giant, Procter Gamble, PG, this time in consumer staples.
Ah, yes, PG.
They boast an even longer dividend growth history. 67 years, and a yield of around 2.5%. The core idea here, really, is their ability to withstand economic downturns.
Absolutely. When the economy takes a hit, what are the things people keep purchasing?
Necessities.
Exactly, the everyday essentials that PG produces. Brands like Tide, Gillette, Pampers, Oral-B, they're just ingrained in our daily lives. Our source basically labels PG as the ultimate powerhouse of recession resistance.
And their ability to set prices, their pricing power. It's quite remarkable.
It really is.
It's fascinating how a company with such a massive global footprint can navigate inflation. They largely maintain their profit margins by passing on costs, and people still buy this stuff.
Because they need it or trust the brand.
Right. That speaks volumes about the strength of their brand portfolio.
So the thinking goes, if the market hits another rough patch, PG is likely to remain pretty steady, maybe even perform strongly relative to others.
Seems plausible.
Okay, moving on. Another consumer staple, Coca-Cola, KO. Offering a yield of about 3.2%, 62-year dividend growth record. Now, everyone recognizes the Coke brand, obviously.
Of course.
But our source emphasizes that their business has really evolved beyond just soda.
That's a really critical insight, actually. If you connect this to broader trends in, consumer taste.
Middle consciousness, variety.
Exactly. Coca-Cola has made some very smart strategic moves to diversify. They're into water, tea, energy drinks, ready-to-drink coffee, acquiring brands, developing their own.
And they benefit from owning some of the most valuable brand names on the planet, right? Plus a distribution network that's just
unmatched, pretty much.
Yeah. The source notes that their main revenue model, selling concentrate to bottlers, leads to really strong profit margins and that consistent stream of free cash flow we keep mentioning.
Which, of course, supports those increasing dividend payments. It brings up an important question, about the enduring power of brands.
Yeah.
How does that translate into long-term investment stability?
Right.
Coca-Cola isn't just banking on nostalgia. They have a business model that's fundamentally built to generate consistent cash.
Okay, good point. Now, let's consider PepsiCo. EBU, another major player in this space, yield around 2.8%, 52 years of dividend growth. Our source highlights their kind of snacks plus drinks dividend bliss strategy.
I like that phrasing. It's clever because unlike Coke, PepsiCo gets nearly half its revenue from snacks.
Frito-Lay, Quaker.
Right, big names. The argument is that this diversification gives them an even greater level of resilience compared to just being focused on beverages.
Makes sense. More legs to stand on.
Precisely. This dual approach, snacks and drinks, it offers a more balanced, stable financial picture. What's interesting here is how this mix has fueled over 5 decades of consistent dividend growth. They've navigated all sorts of economic ups and downs. Plus, they're being proactive in areas like sustainability and developing more health-conscious products. That positions them pretty well for changing consumer preferences, too.
So it sounds like PepsiCo isn't just a defensive play. They're also actively looking towards, future growth trends.
Seems that way.
Now, for a company that presents a slightly different story, 3M, MMM, they currently have a significantly higher dividend yield, around 6%.
Yeah, that's quite high for an aristocrat.
And an impressive 65-year history of dividend increases. However, our source characterizes them as more of a turnaround dividend play.
Okay, that's a really important distinction, turnaround play. So if we consider the market right now, 3M has faced some headwinds, right? Legal liabilities, stock price hasn't exactly soared.
Right, some challenges.
But their plan to spin off their healthcare division, plus their ongoing efforts to sort of mitigate those legal risks, that could act as catalysts. It could lead to a more focused, maybe higher growth company down the road.
So while there are definitely some risks involved, that current high dividend yield might be tempting for income-focused investors.
Potential.
The source suggests this could be a contrarian investment. If 3M pulls off its turnaround, investors might benefit from both that hefty income and potential stock price appreciation later.
It's a possibility. But it prompts an important question for you, the listener. How comfortable are you investing in a company that's going through a major restructuring like this? It requires a bit more, perhaps, risk tolerance.
Definitely something to weigh. Okay, next up, Colgate-Palmolive, CL, yielding around 2.6%, 60-year track record of dividend growth. Our source aptly calls them the quiet compounder.
That really fits, doesn't it? They don't generate a ton of headlines.
No, not really.
But their products are probably everywhere in your house. Dominant in oral care, strong in personal care, even pet food now.
Right. It's that reliable, consistent cash flow from essential stuff people buy over and over.
What's compelling about Colgate is just the consistency. Their global leadership in toothpaste and toothbrushes, plus strategic expansion in emerging markets.
Growth potential there.
Yeah, and also tapping into that consumer trend of wanting more premium products within their categories, adding good operational efficiency. And it points towards steady long-term growth.
It's that dependable, maybe less flashy growth that our source finds really appealing. Okay, now moving into a different sector, consumer discretionary. We have Target, TGT.
Ah, Target.
Dividend yield around 3%, 52 years of dividend increases. They're described as the retail innovator you can't ignore.
And in what's been a really tough landscape for a lot of retailers.
For sure.
Target has shown a remarkable ability to adapt and innovate. If we think about how people shop now.
Online, in-store, pickup.
Exactly. Their successful integration of online and physical stores, the omni-channel thing, along with the strength of their own in-house brands, that's allowed them to carve out a really significant, profitable niche.
And they've built a pretty loyal customer base, haven't they? Focusing on style, value, the whole shopping experience.
They have. The source highlights their digital sales growth and those big investments in their supply chain as crucial factors. It supports their earnings and, importantly, their capacity to keep growing that dividend.
It really raises a key question about the future of retail, doesn't it? Which companies are best set up for this blended online and physical world?
Target seems to be navigating it very effectively. Okay, our next aristocrat is Lowe's. Lowe W. Also consumer discretionary. yielding around 2%, 51 years of consecutive dividend increases.
The home improvement space.
Right. They're seen as riding the DIY and housing tailwinds.
Absolutely. Lowe's definitely benefited from everyone fixing up their houses recently, but our source points out their success isn't just tied to that pandemic surge.
No, there's more to it. Their ongoing operational improvements, their e-commerce transformation, and critically, their strategic focus on serving professional contractors, the pros.
Right, the pro segment, that's a big growth area.
It is. And even if the housing market cools off a bit, there's still this fundamental need for ongoing home maintenance, upgrades.
Our houses are getting older.
Exactly. Aging infrastructure. That suggests continued pretty resilient demand for what Lowe's sells. What's particularly noteworthy is their commitment not just to sustaining the dividend, but actually increasing it, potentially faster than their earnings grow.
Wow, okay. That definitely signals a strong commitment to returning value to shareholders.
It does.
All right, finally we arrive at Walmart. WMT. Back to consumer staples. Dividend yield around 1.4%, 51 years of dividend growth. They're rightly called the everyday dividend king.
And that title is well-earned, isn't it? Walmart's sheer size, their global reach, it makes them just indispensable for a huge number of consumers.
Absolutely massive.
And their aggressive push into e-commerce, plus their ability to leverage that scale for competitive pricing, especially when inflation bites. That's allowed them to hold and even grow market share.
So even though the yield is a bit lower compared to some others we've discussed, like 3M.
Yeah, noticeably lower.
Their consistency and just incredibly strong financial foundation make them a core holding for many long-term investors. The source emphasizes their proven ability to perform well in pretty much any economic weather. Recessions, inflation.
They tend to thrive, or at least hold up very well. So if we sort of bring all this back to your initial thoughts about market uncertainty.
Yeah, let's tie it together.
These 9 dividend aristocrats, they share some really compelling characteristics. Things that could position them for continued success, maybe even in an uncertain 2025 and beyond.
Like what specifically?
Well, they're diverse global revenue streams. That reduces reliance on any single region's economy.
Okay.
They generally have that pricing power we talked about to help navigate inflation. They prioritize returning capital to shareholders' consistent dividends, often share buybacks too.
Shareholder friendly?
Very. They tend to maintain prudent debt levels, strong balance sheets, and generate substantial free cash flow. And many are benefiting from big long-term trends, healthcare demand, home improvements, the digital economy shift.
So it sounds like these aren't just, safe harbor investments, places to hide when things get rough.
No, not necessarily just defense.
They can actually be seen as strategic growth engines for building wealth over the long term, offering that blend of stability and potential for continued expansion.
Precisely. I think that's a good way to put it. For you, the listener, these companies represent a compelling combination of resilience and potential upside. They might not be the flashiest stocks making headlines every day.
No, definitely not.
But their consistent performance and that dedication to increasing dividends year after year, it offers a well-trodden path towards achieving long-term financial security. And maybe just as importantly, that invaluable peace of mind, especially when the market landscape feels a bit shaky.
Well said. So as you consider your own investment strategies, maybe you're just starting out, maybe you're refining your existing portfolio, it seems worth giving serious thought to the role these dividend aristocrats might play in helping you reach your financial goals.
Absolutely. Which leads us to maybe a final thought for you to ponder. Which of these dependable, long-established companies, these sort of reliable legends, best aligns with your own individual long-term financial objectives? And maybe what further investigation might reveal about their specific potential in the current economic environment?